What if I told you that the federal tax code may allow you to pay a 0% tax rate on a portion of your retirement income? My name is Mike Heatwall, and I am the founder and CEO of the Dala Group, a wealth management firm focused on helping retirees. In this video, we will discuss a little-known tax strategy called capital gain harvesting that may allow you to sell investments without paying taxes on the growth. So what exactly is capital gain harvesting? Simply put, it's a strategy where you intentionally sell investments to take advantage of low capital gains tax rates, especially when you're in a lower tax bracket during retirement. This can help you manage your taxable income and potentially save a significant amount of money. Let's break down how capital gain harvesting works. Imagine you have a stock that's appreciated in value. When you sell that stock, the profit you make is called a capital gain. In retirement, your income might be lower, so you could be in a lower tax bracket. This is the perfect time to consider selling some of your appreciated investments. Here's why it matters. If you're in the 0% capital gains tax bracket, you won't pay any federal taxes on your gains. Before we dive into an example, let's talk about the steps involved in capital gain harvesting. Step 1, review your portfolio. Take a close look at your investment portfolio. Identify assets that have appreciated and consider which ones you might want to sell. For instance, maybe you invested in Apple or Amazon 10 years ago, and the position now makes up a significant portion of your overall portfolio. Although you still believe in the company, you don't want your retirement to go down in flames if this one company disappears tomorrow. In this case, we would reduce this holding and reposition those funds into other investments. Step 2, understand your tax bracket. You need to know your current income and capital gain tax bracket. This will help determine how much you can sell without moving into a higher tax bracket. Remember, staying within the lower tax brackets is key to maximizing your savings. Let's look at the tax brackets to gain a better understanding of how this works. Okay, let's look at the two different tax brackets that we need to deal with when we're talking about taxation. So for federal income taxes, you've got married filing jointly and single, and then you have the tax rates running down the page here. So you can see for various tax rates, 10, 12, 22, you have different ranges that you would fall into. Now where it gets interesting is when we take into account the long-term capital gains tax rate bracket. What you'll notice is that for married filing jointly, a 0% rate is applied for any long-term capital gains under or equal to $94,000. And when I compare that to the federal income tax bracket here, you'll see that that means if we are in the 10% or the 12% federal income tax bracket, our long-term capital gains will be taxed at a 0% federal rate. Now remember that long-term capital gains come into play when you have invested in something, held on to it for at least 12 months, and are now selling that at a gain. So when we have that long-term capital gain, that is the amount of money that's applied towards this $94,000 number and therefore is taxed at that 0% rate. We'll get into more details later, but I want to make sure you understood the two different types of brackets here in terms of federal and then long-term capital gains tax. Step 3, pay attention to the details. Implementing this strategy can get tricky. When you sell an investment and realize capital gains, the capital gains are included in your adjusted gross income on your tax return. This can affect the taxation of other income sources such as Social Security. So it is not as simple as comparing your AGI to the capital gain tax bracket to determine how much you can sell. Let's look at a scenario using our tax software. Okay, so here's the tax software we're going to be using today. And I have entered two scenarios into the tax software. So one is a retiree, Tom and Mary, who are under the standard deduction. And the other one is Tom and Mary when they are over the standard deduction. I will explain what those mean in a minute here. So let's start with the basics. We're going to start with scenario 1 here, tax year 2024. And I'm going to scroll down and just show you what some of the entries are. So I added in some taxable interest, let's say from CDs or bonds. We have qualified dividends. These would be from things like stock. And then you have your total dividends, which would include this qualified dividend as well as non-qualified dividends. So non-qualified dividends would be things like REIT income, which is real estate investment income. Then we've got gross Social Security, so $40,000 for the household. And we've got $3,500 of capital gains from the sale of some investments during the year. So what I'm going to do is keep those same variables the same across all of the scenarios that we're running here. And so you can see across the board on scenario 1, 2, 3, and 4 that I have shown, you've got the same taxable interest, the same dividends, the same total dividends, the same gross Social Security, and the only thing we're changing is those long-term capital gains so that you can see the difference between the different scenarios. So let's start with this scenario 1. What we'll notice is if I scroll down, you'll see a total income of $12,750. Now, where does that number come from? That number is going to come from $4,000 of taxable interest, plus $5,000 of total dividends, so that's $9,000, the $250 of taxable Social Security, and the $3,500 of total capital gains. That gives us a total income of $12,750. So if we look at the tax report, we're going to come here and we'll see Tom and Mary, $12,750 in total income, and total tax is $0. Now, why is the total tax $0? You'll notice that the deduction, the standard deduction for a retiree is a married filing jointly retiree, is $32,300, assuming that they're over 65. And so in this case, we only have $12,750 of taxable income and $32,300 in deductions, which leaves us with no tax due. And you'll see that here, right? We're at 0, and for capital gains, we're taxed at 0. Now let's go back to scenario 2 now. And what I did in scenario 2 is I added an additional $10,000 of capital gains. Now if you see here, instead of $3,500, it's now $13,500, which when we make that change, notice that more of Social Security becomes taxable. So you can see that interchange between capital gains and Social Security. So instead of $250 being taxable like it was in scenario 1, we now have $5,250 that's taxable. So when I scroll down, the taxable income, now notice this, is in scenario 1 it was $12,750. I've added $10,000 in capital gains. So if intuitively we would think the total income would only go up to $22,750 by adding $10,000 to this number, but instead it goes up to $27,750 because of the extra taxable Social Security income. So if I look at the tax report for scenario 2, you're going to see that here. I have total income of $27,750. We still have the same standard deduction, and therefore we have no total tax due. So, as you can see, I've added $10,000 of capital gains without affecting the tax bill at all for federal. Let's keep going. Let's keep pushing this. What if I get up to $30,000 in capital gains beyond what I started with? So again, I'm going to come up to the top so you can see the difference. Now you'll see instead of $3,500 that we started with, we're at $33,500 for long-term capital gains. And notice what that does to the taxable Social Security. It goes from $250 to $5,250 and now up to $21,725. So you can see it's increasing significantly there. And so that brings our taxable income now, or our total income, to $64,225. So let's look at the report on this. We've got that total income number there. We have the deductions of $32,300. So now we've got this taxable income of $31,925, which is just taking your total income minus your deductions, gets us to that taxable income number. But notice that the tax is still 0. Now, why would the tax be 0 if our taxable income is $31,925? And the answer to that is the long-term capital gains tax bracket on those gains. So notice the federal income tax bracket, we're still sitting at 0. And here we are down here for the capital gains tax bracket is we're sitting at $31,925 versus that $94,000 limit. So when I look at that, intuitively we would go, well, we can add another $60,000 to this equation, right? And still be under that $94,000 and still pay $0 in taxes. So let's go back to that main page. So you can see I've gone from 30 now up to 75,000 to get us closer to that limit. So if I start at the top again, all the same taxable interest, dividends, Social Security, gross Social Security is still the same, but now notice that the taxable Social Security has gone up to the maximum, which is 34,000. So there's a maximum of 85% of your gross Social Security becomes taxable if your other income is high enough, and that's what we're hitting in this scenario. So we're at 34,000 now on the taxable Social Security. The long-term capital gains are now at 78,500 versus what we started with, which was 3,500. And then you can see now the total income is $121,500, so $121,500. Now, what does that mean in terms of our tax bill? So let's go to that report. So now at the top here, you can see total income is $121,500. Deductions are $32,300, which is the same as it was before. And so when I subtract those two, it's $89,200 is your taxable income. Now notice that only generates a total tax of $820. So we have been able to take $75,000 in capital gains while only paying $820 in federal tax, which is incredible. So when we come down here, you'll notice that we're still sitting in the 10% tax bracket for federal income. And down here, we are still underneath that 94,000 number for capital gains. So none of our capital gains are taxable. The only reason that this kicked off some tax on us is because of that taxable Social Security number being up at 34,000 now. So hopefully that helps you kind of picture what's going on in terms of the interplay between long-term capital gains and Social Security and your other income. But in order to drive this home, I have another sample that I want to show you, because I started with a sample of a retiree that's under the standard deduction. Now what I want to show you is a retiree that has a more retirement income, so they have higher retirement income to start with, and so their Social Security is already taxable, and then how that will work. So let's go there. So here's the main page for this second example that I'm providing you. So again, we're going to use Tom and Mary as our sample, and we're starting in year 2024, and let me just show you what we've got going on here. So we've got taxable interest of $4,000, total dividends of $5,000, and now we've added in this IRA distribution of $25,000, which is not uncommon for our retirees, right? A lot of the times you need to take some money out of your investment accounts in order to be able to, meet your living expenses. So we now have that piece in there. We still have the same $40,000 for gross Social Security, and we still have the same $3,500 for long-term capital gains. So the only thing I changed was adding in that $25,000 of IRA distributions. Now notice what that does is down here for total income, that puts us at $54,975. So let's look at the graph that we've been looking at for the other scenarios. So in this example, we have a total income of $54,975, the same standard deduction, which leaves us with a taxable income of $22,675. And that leaves us with a total tax bill of $1,668. Now, where is that coming from? You can see we're in the 10% tax bracket for federal. $16,675 is applied towards that 10% bracket, which is where the total tax comes from. For capital gains, it's being taxed at 0%. So that $3,500 of capital gains is at 0%. So let's look at the next piece. So now I say, well, let's push that further. What if I add $70,000 in capital gains here? What does that do? So you'll notice if I come back up to the top, all the same numbers here. And now we've pushed this up to $73,500. So we've added $70,000 in capital gains, long-term capital gains. You can see that it pushed us up to the maximum 85% taxability on Social Security, which leaves us with a total income of $141,500. So let's check out the report here. So $141,500 is total income minus those deductions, leaves us with a taxable income of $109,200. That gives us a tax bill of $57.93. So we've pushed it pretty far here. We are now into the 12% federal tax bracket. You can see we're about $10,000 over it. We've got $33,200 that's applied towards that 12% bracket, and that gives us a $57.93 total tax bill. Notice also that we have pushed ourselves into our capital gains becoming taxable. So now our long-term capital gains are being taxed at 15%, which is contributing towards this total tax. So what if we wanted to back it down a little bit and get back out of that 15% capital gains tax bracket and bring it down to 0%? That's what I've done on this last example here. So now instead of going up to 70, I've increased it by 50 to pull it back a little bit. And you'll see that up here, right? So all the same numbers. We now have 53,500 for that long-term capital gain number. And now we've got a total income of 121,500. So now if I look at that report, 121,500 minus the 32,300 for deductions leaves us with taxable income of 89,200 or a total tax bill of 3,520. Now notice we're still in that 12% tax bracket, but we are no longer paying any tax on those capital gains. So essentially, we've been able to add $50,000 in capital gains, and the difference between the tax bills, if I come back here and I scroll down, you can see the total tax is $1,668 originally. I've pushed that up to $3,520. So we're adding, let's call it $2,000 in taxes, but we're able to take $50,000 in capital gains and only pay $2,000 in federal taxes on those $50,000 in gains. That's an incredible benefit that if you can take advantage of, we want to take advantage of. I hope that going through the scenarios helped you see how the various tax items affect the income tax rates and the capital gain rates. There's one more cool thing about capital gain harvesting. Let's say you have an investment that has grown a lot, but you still love it and don't want to sell. You can use this same strategy to sell the investment and immediately buy back the shares. This is known as tax gain harvesting. Here's how it works. After selling the appreciated asset, you can buy it back immediately. This resets the cost basis to the current higher value. In the future, when you sell the asset again, your taxable gain will be smaller as the gain will be calculated from today's value instead of the value from when you originally purchased the shares. Now, some of you might be saying, Mike, what about the wash sale rules? This rule states that if you sell an investment at a loss and buy the same investment within 30 days, the loss cannot be claimed for tax purposes. However, this rule doesn't apply to gains, so you can repurchase the same asset immediately after harvesting gains. Capital gain harvesting is a powerful tool, but as the scenario showed, it requires careful planning and consideration. If you found this information helpful, please give us a thumbs up, and don't forget to subscribe for more financial insights. Thanks for watching, and we'll see you next time.